At 10:27 a.m. Bangkok time, the Bank of Thailand let go. The baht, once pegged immovably to the US dollar, broke its tether and plunged, first 10%, then 15%, then deeper, unmoored by panic and gravity. Screens flashed red. Traders in Hong Kong froze. Phones rang in Washington. Within 48 hours, $6 billion had vanished. But one fund didn't flinch. Its positions were closed, profits locked. Capital wired out long before the headlines hit. The collapse wasn't a surprise, it was an outcome. Calculated, modeled, and patiently awaited. The fund hadn't fired missiles, it had written contracts. The trade was simple. Bet that Thailand couldn't defend its currency, bet that the reserves weren't enough, bet that the facade of stability would crack under the weight of its own design. And when the crack appeared, they didn't blink. They exited. The paradox was brutal. One trade, 1 week, one fund, and an entire country's economy ripped open. Banks crumbled. Construction halted. Protests surged. Within months, the panic spread beyond Thailand's borders, across Malaysia, Indonesia, South Korea. It wasn't just a local failure. It was a regional implosion. The world called it the Asian financial crisis. But for those who watched closely, for those who ran the math, it began with a peg, a pattern, and a bet. The day a quiet fund trade collapsed a currency and changed the trajectory of a continent. In the mid-1990s, Southeast Asia was on fire, economically. Thailand posted GDP growth above 8% annually. Malaysia wasn't far behind. Indonesia roared forward. Foreign investors called it the Asian miracle. Towers rose from rice fields. Skylines thickened. Bangkok became the world's most active construction site. Cement demand soared. Imports surged. Capital poured in from New York, Frankfurt, Tokyo. Everyone wanted exposure to Asia's future, and the returns were dazzling. Dollar loans flowed to local banks. Developers borrowed cheap, lent high, and built fast. Real estate speculation became national sport. But underneath the glow of expansion, something else was growing. Quietly, invisibly, a currency mismatch. Most of the borrowed money came in US dollars. But revenues, rents, wages, government income, were all in local currencies. The math worked only as long as exchange rates stayed fixed. And the rates were fixed, or so everyone believed. Thailand had pegged the baht to the dollar at around 25-1 for over a decade. Investors saw it as a promise, a guarantee, a wall. But it was a wall built on reserves, not concrete. And those reserves were shrinking. By 1996, capital had started to flow out. Trade deficits widened. Foreign direct investment slowed. And to keep the peg alive, the Bank of Thailand burned through billions in hard currency. Silently, discreetly, each day more desperate than the last. The architecture of growth was beautiful. But it was balanced on leverage and illusion. And far away, in a high-rise office in Manhattan, a young analyst noticed something odd in Thailand's financial statements. The numbers weren't adding up, and someone was betting that no one would ask why, until it was too late. Thailand was booming. But the foundation wasn't growth. It was borrowed time. By 1997, Bangkok had more cranes than any city in the world. High-rises stretched over canals. Luxury malls opened beside shanty towns. Highways cut through jungles to reach half-empty towers. Everything was under construction. Everything was collateral. The banks lent freely. Developers borrowed recklessly. Office space in Bangkok doubled in 5 years. Half of it sat empty. Condominium prices outpaced income by 400%. Credit cards arrived in middle-class households that had never needed them before. But the real danger wasn't visible in concrete. It was hidden in balance sheets. Thai banks borrowed heavily in US dollars. Low interest, easy terms, endless supply. Then they lent in baht. The spread looked safe, profits were strong. But the risk was lethal. If the baht devalued, those dollar loans would double overnight. The system relied on one assumption: The peg would hold. The Bank of Thailand defended it like doctrine. Pegged at roughly 25 baht to the dollar, the currency was stable until it wasn't. By early 1997, the central bank was burning through reserves. Almost $1 billion a week disappeared in silent interventions. Officially, the country had $30 billion in reserves, but much of it was already pledged, tied up in swaps and forward contracts. The real number was lower, much lower, and the capital flight had begun. Imports surged while exports slowed. Trade deficits widened. Investors grew uneasy. Whispers turned into strategy. Currency traders began to circle, not yet attacking but watching. To the public, there was no crisis. Skyscrapers still rose. Government officials repeated the mantra, "The baht is strong, the economy is sound." But the math disagreed, and markets listened to math, not ministers. In this fragile silence, the stage was set, not for a crash, not yet, but for a test, one that the baht would not survive. He was 32 years old, MIT trained, a trader shaped by math, not ideology. His apartment was modest, but his mind ran on billion-dollar logic. He didn't wear suits. He wore gray hoodies and carried printouts of IMF bulletins in a backpack stained with coffee. His obsession wasn't Thailand. It was imbalance. By 1997, he was working at a small but aggressive macro hedge fund based in Manhattan, a firm built not on scale but on speed. They didn't manage pension plans. They hunted distortions, currency mismatches, sovereign debt spirals, interest rate gaps, markets where policy pretended longer than fundamentals allowed. And Thailand was flashing red. He started with public data. Thailand's balance of payments, trade deficit, interest rates. Then he ran models, recursive loops, simulating capital flight, real estate correction, investor panic. At first, the outcome was blurry. Then it sharpened. The Thai baht was overvalued, deeply, dangerously. The official exchange rate held firm at around 25 baht to the dollar. But under the surface, reserves were hemorrhaging. The central bank was defending the peg with forward contracts, secret ones. Commitments to deliver US dollars in the future, artificially inflating reserve numbers. It was a counting sleight of hand invisible to the casual observer, but not to him. He called it a math problem disguised as a currency. In internal notes he wrote, "Thailand has 30 billion in visible reserves, but 23 billion is already committed. The peg is a mirage." His recommendation? Short the baht. Not recklessly, not loud, quietly. With precision, use non-deliverable forwards, offshore swaps, deep out-of-the-money options. Start small, build pressure. The goal wasn't to trigger collapse. It was to stay ahead of it. He pitched the idea to the fund's partners. At first, they hesitated. Thailand wasn't Russia. It wasn't Argentina. It was a U.S. ally with strong GDP numbers and World Bank praise. It hosted global investors. Rating agencies still gave its debt investment-grade status. Besides, breaking a currency peg was risky. If the Thai central bank fought back hard, the losses could be swift. But the trader showed them the numbers. Current account deficit exceeding 8% of GDP. Dollar-denominated debt rising twice as fast as exports. Real estate vacancy in Bangkok over 40%. Capital inflows reversing. The picture wasn't just fragile, it was doomed. He said, "The question isn't whether they break. The question is whether they survive trying not to." The fund approved the trade, modestly at first, a few $100 million in exposure, then more. The trader moved fast, placing forward contracts to sell baht, positioning through offshore brokers in Singapore and Hong Kong, using US dollar call options as a hedge, structuring it to survive volatility. But he wasn't alone. Other funds noticed. A few began to take similar positions, some out of conviction, some out of fear of missing the collapse. George Soros's quantum fund had already tested the peg months earlier, a sharp move, then a pullback. But now the pressure was coordinated, if not spoken. The Bank of Thailand noticed. Daily currency interventions grew larger. Rumors began to swirl. Hedge funds were attacking. Thai officials went on television vowing to protect the baht at all costs. Analysts dismissed the rumors. The Thai economy was resilient. GDP growth remained above 6%. Bangkok's skyline glistened. But the trader didn't trade headlines. He traded pressure. He saw the capital outflows. He tracked interbank lending rates spiking in Bangkok. He noticed gold buying rising in Thai households, a signal of local distrust. He watched real estate ads offering pre-construction discounts, a euphemism for panic. Still, he didn't believe he was doing damage. "We didn't build the leverage, we just measured it," he told a journalist years later. Markets don't break countries. They reveal who already broke them. He wasn't betting against Thailand. He was betting against arithmetic, and against the belief that a promise, repeated long enough, becomes a truth. In the fund's internal systems, the position was called B25, Baht 25. If it held, losses would be minimal. But if it broke, the upside was exponential, and the wall was cracking. Every dollar sold by the central bank confirmed the trader's thesis. Every official denial fueled his conviction. Every dip in Bangkok real estate prices, every whisper from regional analysts, it all pointed one way. By June 1997, the fund's exposure had tripled. The position was active, the math was locked in, and the moment was approaching. In the back rooms of Bangkok's financial system, desperation simmered. The Bank of Thailand was bleeding reserves at a rate no economy could sustain. Between May and June 1997, they spent over $9 billion trying to hold the peg, quietly selling dollars to buy up the baht. Each intervention was larger, each one less effective. But in public, the posture remained calm. The Prime Minister denied capital flight. The central bank gave interviews affirming the strength of the baht. The Finance Ministry issued statements dismissing speculative pressure. It was all theater, and the actors were growing tired. Behind closed doors, the Thai government knew it was under attack. They didn't call it a trade. They called it economic sabotage. Foreign hedge funds, they claimed, were waging financial war, selling off the baht in massive volumes, driving down confidence, spreading rumors, creating instability. The narrative caught fire in domestic media. The Thai public began seeing the crisis not as structural but as a foreign conspiracy. But none of it changed the numbers. The short positions kept growing. The fund in New York wasn't the largest, it wasn't Soros, it didn't make headlines, but its trades were clean, strategic, and calculated. Using offshore currency forwards, non-deliverable contracts settled in dollars, they avoided capital controls. Through counterparties in Singapore and London, they scaled up exposure without triggering alarms. Each position assumed one thing, that Thailand could not survive the drain. And Thailand was draining fast. The peg was set at approximately 25 baht to the US dollar. But the forward markets, where traders could bet on future prices, were already pricing the baht at 28, 30, even 32. The market was screaming collapse, even as the central bank smiled for the cameras. On June 19, 1997, Thailand raised overnight interest rates to over 20%, an act of defense. It was meant to scare off the speculators, to raise the cost of shorting the currency, to buy time. But time was the one thing Thailand didn't have. The trader watched closely. His model measured each move: reserves, interest rate spikes, bond yields, capital flow reversals. Every defense, every billion-dollar sale of dollars, every hike in interest rates only confirmed the end game. Thailand was fighting gravity with speeches, and gravity was winning. Then came the final week. The short positions across the hedge fund world hit their peak. Reports estimated over $15 billion in speculative capital positioned against the baht, a sum larger than Thailand's usable reserves. The forward contracts, the swaps, the options, they had become a tide too large to reverse. Bangkok called emergency meetings. The central bank huddled with the finance ministry. IMF representatives were quietly consulted, but there were no more tricks left. On July 2, 1997, the Bank of Thailand announced it would no longer defend the peg. The baht was floated, and instantly it fell. From 25 to 29, then 31, then 35. In 48 hours, the Thai currency lost over 20% of its value. A week later, it was down 40%. The stock market cratered. Real estate deals collapsed. Banks went insolvent overnight as their dollar-denominated debts ballooned. People lined up at ATMs. Imports stopped. Inflation surged. The boom turned to ash. The trader's position was closed just before the announcement. Not out of luck, but by design. The model had given a probability spike. The signals had aligned. The trade exited at maximum profit, minimal risk. There were no headlines. No celebrations, just numbers, P&L statements, capital reallocated. In Bangkok, the government blamed the hedge funds, called them financial terrorists. They destabilized our country, one official said. They made money from our pain. But the truth was harder to face. The traders hadn't built the collapse. They had simply priced it before anyone else. Wall Street called it smart. Bangkok called it treason. But the market called it over. In the days before the collapse, Bangkok fought like a regime at war, not with tanks, but with spreadsheets and silence. The Bank of Thailand launched its final defense in June 1997. It hiked overnight interest rates past 20%. It flooded the market with US dollars, selling reserves hour by hour to buy baht and support the peg. The pace was frantic. Traders noticed that bid-ask spreads widened unnaturally. The price of Thai government bonds twisted against fundamentals. Behind the curtain, a financial war was underway. Officials denied everything. The baht remained strong, they insisted in press briefings. But they knew the house was burning. Nearly $1 billion in foreign exchange reserves was being spent per day. By mid-June, more than $15 billion had been used to defend the currency. But few in the public understood what that meant. To most Thais, the economy was still booming. Malls were full. Construction sites buzzed. New cars filled Bangkok's gridlocked roads. But within the central bank, the numbers were unraveling. By late June, officials realized the horrifying truth. Their usable reserves had fallen below $2 billion, a fraction of what was needed to survive even one more week of capital flight. And worse, most of what remained was already committed. Thailand had entered forward contracts with foreign banks to deliver dollars in the future, effectively gambling future reserves to protect the illusion of present stability. It worked for a while, until it didn't. The IMF was contacted, quietly. A delegation arrived. There were no cameras, just hard questions. What was the real reserve figure? What liabilities were hidden off balance sheet? Could Thailand hold the peg another month? The answer came back cold, no. On July 2nd, the central bank admitted defeat. In a one-page press release, they announced the baht would be floated. No more defense, no more fiction. The markets responded instantly. The baht dropped by 16% in a single day, then kept falling. Stock markets crashed. Developers defaulted. Banks faced liquidity crises. Imports became unaffordable. The illusion collapsed, and with it, the government's credibility. Prime Minister Shavalit Yongchayud addressed the nation. He looked stiff, bewildered. He spoke of external forces and speculators. He promised stability. He delivered none. Protests erupted. Within months, he resigned. The central bank governor stepped down shortly after. Across Bangkok, half-finished towers stood still. Cranes stopped. Cement dried in silos. The real estate bubble had popped, but the debt remained. Thai banks held massive dollar liabilities now inflated by the devaluation. Dozens became technically insolvent. Depositors panicked. The government scrambled to arrange emergency liquidity support, and the panic didn't stop at Thailand's borders. Foreign investors, terrified, pulled capital from neighboring countries. Malaysia, Indonesia, South Korea, all showed similar weaknesses. Pegs, real estate bubbles, dollar debt. The contagion spread. What began as a local defense became a regional disaster. Inside the hedge fund in New York, there was no celebration, no arrogance, just silence. The trade had worked. But the magnitude of what followed, the destruction, the human cost, was sobering. The trader who placed the bet later said, "I underestimated how fragile the whole system was. I thought it would bend. I didn't think it would break." Bangkok had fought with billions, but in the end it had nothing left to fight with. Not trust, not credibility, not dollars. Only consequences. July 2nd, 1997. The peg broke. The baht floated. But what followed wasn't a market correction. It was a financial detonation. In just 1 week, the Thai baht lost nearly half its value against the US dollar. Imports collapsed. Inflation surged. Banks bled capital. Incomes evaporated. Thailand's stock exchange plummeted more than 75% from its peak. By year's end, over 60 financial institutions would be shuttered or nationalized. Growth fell off a cliff. A decade of gains, gone. But Thailand was just the beginning. Foreign investors began to panic. If the baht could fall, so could the ringgit, so could the rupiah, so could the won. The hedge funds that shorted Thailand now turned to its neighbors. And like a forest lit with dry kindling, the entire region went up in flames. Malaysia was next. Its current account deficit hovered near 5% of GDP. Its stock market was inflated by speculative flows. Real estate was overheating. And like Thailand, it maintained a quasi-peg to the dollar. Foreign investors dumped Malaysian equities and bonds. The ringgit collapsed by over 45%. The Kuala Lumpur Composite Index lost 75% of its value. Mahathir Mohamad, Malaysia's prime minister, lashed out at rogue speculators and accused foreign hedge funds of economic sabotage. But it didn't matter. The panic had its own momentum now. Indonesia followed. With dollar-denominated debt, a weak banking sector, and deep political vulnerabilities, it was uniquely exposed. When the rupiah fell, it fell like a stone, from 2,400 per dollar to over 16,000 in less than a year. Inflation hit 80%. Food prices doubled. Riots erupted. President Suharto, who had ruled Indonesia for over 30 years, was forced to resign. A currency collapse became a political revolution. South Korea came last, thought to be too large, too developed, too organized to fail. But no one was safe. Korean chaebols were over-leveraged. Debt-fueled expansion had turned balance sheets toxic. By late 1997, Seoul requested a $58 billion bailout from the IMF, the largest in history at that time. Protesters flooded the streets. The national mood turned bitter. South Korea's GDP contracted sharply, and unemployment tripled. Across the region, central banks begged for help. Bailouts came, but at a price. The International Monetary Fund demanded austerity, cut government spending, raise interest rates, close insolvent banks, liberalize capital markets. These policies stabilized currencies, eventually. But in the short term, they deepened the pain. In Thailand, suicide rates rose. In Indonesia, poverty exploded. In Korea, citizens lined up to donate gold to the government. Their jewelry melted to support the National Reserve. Over $600 billion in market value was erased in less than 12 months. The Asian miracle had turned into the Asian contagion, and all of it had started with a currency peg and a trade. The fund that shorted the baht was out long before the region collapsed. The position had closed days before the official float. Profit was booked. Risk was zeroed out. No celebration, no press release. Just numbers on a screen, cleared and gone. The trader moved on to other trades. Russia, Brazil, tech stocks. He never spoke publicly. He declined interviews. But the blueprint he followed became legend. It wasn't the size of the trade that mattered, it was the timing. He hadn't needed to short the entire region. only to identify the first crack. Because in over-leveraged systems, contagion is not a consequence, it's the rule. A few funds made billions, many more were caught in the storm. Asian governments restructured. Political careers ended. Central banks rewrote their playbooks. And in Bangkok, the skyline stood frozen. Towers half-built, cranes abandoned, mortgages unpaid. A generation scarred not by war or ideology, but by economics. It had taken just one trade to tip the first domino, just one peg to break, and 48 hours for Asia to fall. He didn't give interviews. He didn't appear on magazine covers. His photo wasn't in the Wall Street Journal. His name never publicized. The trader who cracked the Baht wasn't looking for credit. He was already gone. The fund returned capital to its investors that quarter, up nearly 120% on currency positions alone. The firm grew in size. New hires came in, bigger desks, more screens. The strategy that worked in Thailand was now being applied in Brazil, Russia, and South Korea. But the trader left. Not out of guilt, not out of pride. Just completion. He had seen the flaw, built the model, executed the trade, and stepped away. Not many noticed. A few hedge fund insiders knew. Some institutional clients were told in whispers. But to the world, the story remained attached to bigger names. Soros, Druckenmiller, the macro giants. Yet none of them had shorted the Baht at scale. He had. He kept a file, one folder, labeled B25. Inside, printed reserve reports, IMF forecasts, a single spreadsheet with columns of cash flow models and an exit date circled in pencil, June 30th, 1997. 2 days before the float. The page was yellowing now. The trade was history. He never wrote a book, never taught a course. He lived quietly. Sometimes in New York, sometimes in Lisbon. Occasionally attended lectures on sovereign debt. Always in the back row, always listening. When asked, years later, what he learned, he said, "You don't need to predict the collapse. Just find the part everyone refuses to price." He didn't celebrate the outcome. He didn't gloat, because what came after the trade wasn't victory. It was chaos. He had watched countries bleed, watched families lose homes, savings, futures, all over an economic structure built on borrowed money and a promise that a peg would hold forever. It hadn't. And still, the cycle continued. Other nations learned. Some did not. Pegs were restructured, repegged, hidden under baskets or crawling bands. But the laws of finance never changed. A fixed exchange rate backed by shrinking reserves is not stability. It's delayed collapse. He once scribbled a line in the margin of a notebook. Markets don't kill countries. Denial does. He framed nothing. He posted nothing. Because he hadn't set out to be remembered, only to be right. And he was. What rose from the wreckage wasn't recovery. It was redesign, supervised by men in suits, holding briefcases with the IMF seal. Thailand was first. In exchange for $17.2 billion in emergency funding, it agreed to sweeping reforms. Shut insolvent banks, liberalize capital markets, cut government spending, raise interest rates. It was austerity wrapped in diplomacy. The IMF called it stabilization. On the streets, it felt like surrender. Hospitals cut staff. Infrastructure projects were halted. Public employees went unpaid. Small businesses failed as credit dried up. The Baht stabilized, but trust fractured. Malaysia refused. Mahathir Mohamad, its prime minister, rejected the IMF's script. Instead of liberalization, he imposed capital controls, fixed the ringgit, banned offshore currency trading. The West called it reckless. Wall Street called it suicidal. But it worked. Malaysia contained the panic, avoided mass bankruptcies, protected its banks. Years later, even IMF officials admitted the capital controls had merit. But in 1997, Mahathir stood nearly alone. a nationalist in a world of neoliberals. Indonesia spiraled. The IMF's $43 billion package demanded deep reforms. Suharto agreed on paper, but resisted in practice. Riots erupted, cities burned, the rupiah cratered. By May 1998, Suharto was gone, toppled by inflation, unrest, and a currency crisis that turned political. Indonesia didn't just restructure its economy, it changed its regime. South Korea became a symbol. Its IMF bailout, $58 billion, came with harsh strings. But instead of rejecting the program, Koreans rallied. They donated gold to replenish reserves. They accepted wage cuts. The country reformed its conglomerates. Painful, yes, but in time, Korea rebounded stronger, faster, leaner. In Washington, the IMF declared victory. The crisis, they said, proved the importance of fiscal discipline, capital mobility, and transparency. But critics saw something else, a blueprint for Western control. Economies shattered. Social contracts dissolved. Domestic policies were written in foreign boardrooms. It was no longer just about interest rates or inflation targets. It was about sovereignty. In the post-crisis world, Asian nations learned a hard lesson. Never depend on Western capital without defenses. Never run out of reserves. Never allow Washington to write your rescue terms. China took notes. It hoarded reserves, built its own firewall, prepared for a storm. So did Singapore, Taiwan, and others. The dollar had won, but trust in the global financial order had eroded. Because in the end, it wasn't just the baht that broke. It was the illusion of independence. In the end, there were no missiles, no invasions, no ultimatums. Just contracts, just numbers. A quiet, short position, a currency defense that ran out of time. And within 48 hours, markets collapsed, governments fell, and the shape of Asia changed. The trader didn't raise a hand. He raised a probability. And the baht, along with the myth of the unbreakable peg, shattered on schedule. The cost? Over $600 billion in losses, 3 IMF bailouts, 1 toppled regime, millions of lives altered. All triggered not by armies, but by margin calls. No territory was conquered, yet power shifted. Sovereignty bent. And in the vacuum, institutions like the IMF and funds from New York filled the void. Because financial warfare doesn't wave flags. It whispers through interest rates. It strikes through spreadsheets. It invades through liquidity. And when it's over, there are no soldiers to bury. Only balance sheets. The Thai baht crisis didn't end with headlines. It ended in silence. In lost decades, abandoned towers, rewritten textbooks. But it left a mark, a warning, that currencies fall faster than empires. That denial, not debt, is the deadliest liability. And that a system can collapse without anyone firing a shot. Subscribe to Shadow Empires, where money became warfare.